Hi, Bruce Miller here. June 2012. What a month it was. A month of ups, a month of downs. First, it looked like it was going to be an extension of the truly miserable quarter we've had so far. But in the end, on the very last day of the month, a big rally, and we finished the month up about 2%. Still a lousy quarter, but at least June finished okay. But it was not without incident. I'd like to go over some of the key things that occurred during the month and tell you what we think is going to happen in the future, as if we may know that. Anyway, the first thing, of course, was Europe. They've dominated the headlines for some time. Two key things right now in Europe. One is the big Spanish bailout, much bigger than Greece. 120 billion just to bail out the banks, and then the sovereign debt itself is another issue. It will require quite a bit of support from the Eurobank to keep Spain afloat. Greece went through a round of elections, and they were important because they were a decision on whether they were going to go with austerity or go with growth. Stay in the euro or get out of the euro. In the end, the Greeks voted for austerity, and that means that for a while at least they're going to continue on the current path and continue with the euro. There were some other peripheral problems in Europe, including some spikes in the Italian yields on the Italian bonds, which could be an indicator of problems to come. But the Eurobank seems to be taking pretty good control of that lately. Another thing is the Federal Reserve decided to extend Operation Twist. Now, Operation Twist is the program whereby the Fed was trying to lower long-term interest rates at the expense of short-term interest rates. And it has worked remarkably well. You've probably seen the mortgage rates, under 3.75 for 30-year bonds and at 3% or below for 15-year bonds. Truly amazingly low interest rates. That's a result of Operation Twist, and it was supposed to end June 30th. But the Feds decided they were going to continue it. Now, I don't think you're going to see as much effect from Operation Twist as it had the first time, but it did indicate that the Fed is taking some action, and the market reacted positively because of that. Jobs. Not much to say about jobs. They're just stuck at 8.2%. The jobless claims just keep going up, and the employment fulfillment just stays down. It may be a systemic problem that may take years to fix, if it can be fixed at all. You know, it doesn't take as many people to do the same job today as it did 10 or 20 years ago. Technology has eliminated many of those jobs. At any rate, the market seems to behave well in spite of the employment rate. So as far as the market goes, I know there's a lot of sad things going on with unemployment, but the market seems to be ignoring the unemployment figures. Another key thing that occurred, not the most important, is Obamacare. On June 29th, the Supreme Court decided that it was okay to proceed with Obamacare. It was quite a surprise because they decided that it was actually constitutional as a tax, which nobody expected that out of Judge Roberts in the Supreme Court. The effect on the market, initially a negative, but it bounced back pretty quickly, and now we've seen some merger activity because of the more certain future of Obamacare. So those are the financial effects that decision had. And what I think is the most important is the fact that we heard stories about the banks, the Eurobank, the Bank of England, the Federal Reserve, acting in concert together to be there, to provide a floor if something bad were to happen to the economy. Now, just the very mention of that sent the market soaring. And the reason is because there's a perception now that whatever happens, there's going to be a floor in place as far as how low the market can go. Now, I don't know if that's true or not, and I don't know if the banks can actually do that and make that happen, but the key thing is the perception that that might occur. And because of that perception, we have seen a tremendous drop in volatility since that announcement was made. It has just changed the way the volatility index, which is actually something that's traded these days, it has changed the way that whole market trades. Volatility has been very dampened ever since that announcement has occurred, and I think that's probably a really good thing for the markets. So those are some of the key things, but what's happening next? Well, right now we just started earnings season, and I expect it's going to be a pretty tepid earnings season. I don't think you're going to see the rate of growth that you've seen in the past. Largely, you'll see the market reacting company by company as each company announces their earnings. But all in all, I think we're going to see a bit of a market pullback because I just don't think earnings are going to be as vibrant as people expect. And one more thing is something that you'll hear more and more about, and that's called the fiscal cliff. Now, last year we were talking about the extension of the debt ceiling, and that is the key item that caused tremendous volatility. This year, this may be the fiscal cliff that causes the same. Now, what this means is that if Congress does not take some action by January 1st, that the Bush tax cuts will end, resulting in a tremendous tax increase. Ben Bernanke does not think that's a very good thing, and I don't think it is at this point either. At the same time, many budget cuts will be forced to take effect at that point. So we'll have a reduction in spending, an increase in tax, just at the time the economy seems to need it the least. So that's what June 2012 was all about. And we'll keep monitoring it, and we'll keep providing you the information that we see day to day, so pay attention to our blog. And in the meantime, Ben, let's go make some money.